Hi, everybody. Welcome to Friday's Focus on Finances. My name is Jamie Fleming, and I'm coming to you again this week with some financial information that will hopefully be beneficial and improve some of your personal wealth and financial well-being. And I'm coming today, and I'm specifically addressing the biggest mistake successful women entrepreneurs make when it comes to their retirement, investing, and savings. This is not to say that our male counterparts don't make the same mistakes, but what I want to share with you is some of the conversations I've been having with some of my new business clients that happen to be women entrepreneurs. And for most of you that may not realize it, a large part of my clientele is working with business owners and entrepreneurs. So right now, this fourth quarter, in our financial advisory business, it's our busiest time of year because there are certain things that entrepreneurs should be looking at before year end to take advantage of not only personal savings and investing, but also some of the things that are available to transfer your business wealth to your personal side and get the deduction on your business without increasing your individual side income. So hopefully I can give you some information that's timely because we are at December 11th, Friday, December 11th, and we have until December 31st to put some of these things in place. So that gives you 20 days, less than that because it's a holiday, right? So it's our busiest time of year and it's our busiest month for a lot of reasons. We have a time crunch and deadline. Plus, we have fewer working days. So I want to give you this information. If you have questions, please connect with us either via Facebook. You can DM us. You can send us a message. You can text us, whatever you need to see if some of these things can be put in place in time. So one of the conversations I had with a new client the last couple of weeks was that her CPA has been telling her every year that she needs to open up a solo 401k plan because she's generating sufficient revenue on her business side and she's paying herself sufficient income, $100,000 a year on her personal side, and she's paying a lot in taxes. So she gets that information from her CPA as he's doing the tax preparation, which means she can't benefit from that for the year that he's actually doing the taxes, but he's letting her know, going forward, you should do this. So this was in February, March of this year. So she shared with me that she went on because there are places and different firms that have free financial services that supposedly help you put things in place. And they went through a process, her and her husband, and they have the ability to open up a solo 401k through the firm. And she expressed that desire, but nothing ever happened. So the free service did not follow up with her. There was no assistance in opening these things up. So what happened then, because it became a little bit more complicated than trying to do it on your own, it just didn't get done. So that was February, March of this year. Now we're in December. And we were talking, and she expressed to me, I probably just don't feel the pain of not doing it. So I thought I would share with you, especially we have so many people that have done so well in their business despite the pandemic. We have lots of industries that have been hit hard. We have the restaurant industries, we have museums, we have the arts, we have all of those areas that have been hammered. Yet we have a lot of businesses that have actually done quite well and are generating well over 7 figures. What they haven't done, though, is they haven't done a lot of tax planning and saving and investing planning. And so hopefully some of this information will help. So going back to this person that got the advice from their CPA, who can't implement the advice, but giving them advice on how to save on taxes. And now fast forward 10 months, 11 months later, it still hasn't been set up. So now we're in the current year, the person's done very well in their business, yet we still don't have any savings and investing. So here's the pain of not doing that, right? Here are some numbers of just 1 year of not contributing to the retirement plan. And in her case, she could have invested or put away $19,500 from her salary into the solo 401k. And because she's actually the employee and the employer, her employer, which is her, could actually add an additional 25% of her gross income, because she W-2s herself, 25% of her gross income, which is another $25,000, that would reduce the taxable revenue of her business, transfer her business revenue to the personal side, right? And not increasing her personal income tax. So for her, that 19,500 and 25,000 would equate to 44,500 that she could have put away via personal deduction and business deduction in her solo 401k plan. Okay, so what does that mean? So that's 1 year of not doing it. In 10 years, the cost of her not doing it for 1 year was 87,500 if we just invested it for growth at 7%. That one contribution in 10 years cost her 87,500. Now, the interesting thing also, as we were talking about, she was saying, I just haven't had a lot of money for someone to invest for me. So I don't have a financial, or I hadn't had a financial advisor because I didn't have a portfolio big enough. So here's the other thing to realize, okay, is that there are two pieces of the puzzle. When people use the term financial advisor, that's really an umbrella for a lot of different things. So a financial advisor can be someone who just manages your portfolio, which is what she was referring to. She says, if I had, the minimum for a lot of advisors, portfolio managers is 100,000, because I don't have that. So I have never hired a portfolio manager who refers to themselves as a financial advisor, right? And so that person, when you're hiring a portfolio manager, that's exactly what they're doing. They're managing that portfolio. But some people feel, or they mistake the fact that that's their job. Their job is to manage that piece of the puzzle, but they're not necessarily doing financial planning and strategies for you that includes all the other aspects in your world, your individual world, your business world, whether you have kids and we have to do college planning, if you have a home or you want to buy a home. All these areas fall under the financial planning umbrella, which most people also refer to as a financial advisor, but those are two different sets of roles. Now, I've been doing this for 30 years and I've added things to my financial advisory toolbox. I do both, but not everybody does. A lot of financial planners don't do portfolio management, and vice versa. Portfolio managers don't do financial planning. There are a combination of people that do both, like myself. So we look at both sides of the equation, but the confusion comes on the consumer side. When someone's looking for a financial advisor, most of the time they're thinking, well, I don't have the money. Well, let me share with you what happens when you don't hire a financial planner to help you input some of these and implement some of these strategies that we're talking about. So we talked about the pain of this one person not contributing for 1 year in their retirement plan. And she's doing quite well. She's very successful. She has not been hurt financially by the pandemic. So it's even a greater piece of the pie to really look at where are you in your situation. And she's on the younger side, so she has time on her side. So that 1 year cost her $87,500. That was pretty painful to hear. It also meant that she paid $16,000 more in taxes than she had to if she had implemented the strategy. So when we look at the fact that you're going to pay the taxes if you don't implement some of these strategies, then when you look at hiring somebody for the thing that you couldn't do on your own, it would have saved her $16,000 in taxes and increased her personal wealth by $44,500 in 1 year, $87,500 in 10 years, just by investing conservatively. I can tell you that hiring someone to help you implement those strategies would cost way less than the $16,000 she paid in taxes, and certainly far less than the $87,500 she's missing out in personal growth. So one of the things I want to point out, and one of the biggest mistakes women entrepreneurs make, is that we are juggling a lot of pieces of the puzzle most of the time. Okay, most of the time. So like myself, which this person and I related because we have very similar life makeups. We both have businesses that we're running. We both have kids. And then she has a spouse on top of that. So as women entrepreneurs, we're usually juggling a lot of different roles. So if something doesn't flow quite right, then it gets put on the back burner. And unfortunately, one of the biggest mistakes women entrepreneurs make with savings and investing is that when it doesn't flow quite right and it gets pushed back, it costs us $87,500 just to miss 1 year. And the reason why those things happen is because we're not putting ourselves first as far as pay yourself first. It's one of the things I talk about in my Kick the Fear Out of Your Finances program. Is paying yourself first is one of the best ways to accumulate personal wealth. And the way to do that is to look at your revenue and your income every single month and putting a percentage of that away every single month, so you're not waiting. So right now, if we look at this scenario in December, I'm sharing with her, we can save you, not only save you $16,000 in taxes, but we can also generate an additional $87,500 in personal wealth by putting this strategy in place. Now, does she have $44,500 just sitting in her bank account right this second? She doesn't, right? And so that's part of the problem with waiting to the last minute. What she does have is she has enough money to fund it partially, right? And the part that we want her to fund partially is the part that she needs to do before December 31st. Because the good news is that the employer side, which remember, she's both. She's the employee and the employer. The employee side, we have to fund before December 31st, or run the payroll part of it before December 31st to take advantage in 2020. The good side about the employer contribution is that we have until we file the corporate taxes to fund the employer side. So this is where tax planning is critical. I do tax planning the fourth quarter every year for myself and my business. And you do that for a number of reasons. One, you want to see what your tax liability is. Most business owners are doing their taxes in the first quarter of the following year, and they're shocked with the tax liability that they now have to come up with. So not only do they have a tax liability, but they were told, oh, you can also invest into a retirement plan. So they have to come up with these large sums of money. And this is what I talk about, doing the little things consistently over time versus all at once. So our business clients, what we do every year is we work with them on a monthly, quarterly basis so we can look at and analyze personal and business cash flow so we can start putting money away before the end of the year. That's ideal. And what I can tell you is that the clients that do that, the clients that put money aside throughout the year, put much more away over time than the client who waits till the last minute and has to come up with maybe additional tax monies and contribution monies. And that's tough. I mean, we're talking sometimes 6 figures, and they don't always have the cash flow to do it. So the biggest mistake is, one, waiting to the last minute so you can't take advantage. And we were talking about this too, is that she goes to her CPA every year literally because she has to. Because if she doesn't go to her CPA, she can't do her own taxes because they're complex enough. She could, but that probably is not a good idea. So she does hire a CPA to do tax preparation for her, right? And she does that because if she doesn't, and she doesn't file her taxes, then the IRS is going to give you some bad news, and they do not mess around. So penalties and late fees and all those things that go onto it. So most people don't like to do their taxes. Most people don't like to go see their CPA, but they do it because they have to, because the consequence of not doing it and not filing your taxes, the consequences are so high that you do it. Now, interestingly enough, the consequence of seeing or hiring a financial planner and portfolio manager, not hiring them, you don't see the pain because you don't get a penalty from the IRS, right? You're not given a notice that said, hey, if you had hired a financial planner and they put the strategy in, then guess what? Your $16,000 tax bill would have been gone. That would be helpful if people could see that. Hey, you didn't hire that financial advisor, but if you had, in 10 years, you would have an additional $87,500 in personal wealth if you just contributed that 1 year. Now, by the way, if you did that over a 10-year period, if the same client contributed the same amount, just consistently the same amount, we didn't increase it, and we still invested it for growth at 7%, that's over $700,000. Now, if you got a bill or if you got a notice every year that said, if you don't hire someone to help you do this, it's going to cost you $87,500 plus $16,000 in taxes, and over 10 years doing the same thing, it's going to cost you over $700,000 in personal wealth and over $150,000 in taxes you're going to pay. You think that would feel like you could afford a financial advisor at that point? Probably, hopefully. And the reason why it doesn't happen is because for most people, and especially business owners don't feel like they have any options. And in all actuality, our entrepreneurs have way more options than our W-2 employees. So we have things that are available to us that the normal individual person doesn't, and it's just based on your set of circumstances. And I'm going to share my screen so you can see what some of the programs look like and what your ability to contribute to those programs look like. But I want to give you this one scenario because most of my business entrepreneurs are paying themselves or are at least making $100,000 in personal income, and then they have additional revenue in their businesses. And this is just the basic kind of average client that comes in. Most of the clients that I'm seeing are making much more than that, and so the consequences are higher, but you just don't know it because no one's telling you. No one's telling you actually the pain that you're going to be feeling later on if you don't do some of these things now. So the important thing to know too is that regardless of what we're talking about right now, if you're in this situation, whether or not you can put these in place sooner than later, or you don't have the cash flow now, you do know now that going forward, going into 2021, you can start doing some planning. So we do end of the year planning for our business clients, right? And then depending on how they were able to implement all this information, we go into the first quarter saying, so I think we had a little technology difficulty there, but we're back. So anyway, with our business clients, our biggest benefit is to do financial planning and tax planning all throughout the year so that you can manage cash flow and do all those things. So that's the benefit of having an advisor that works with business owners, because when you go to the firms that have the free services, sometimes you have to look at the background of the person that's helping you, because on those sides of the coin, many times they're just young people getting started and getting the knowledge and going in. Not to say that's always the case, but if they're not financial planners on top of everything else, then they may not be looking at all the areas that you need. Which, by the way, for my business owners, don't forget also, when you hire an advisor, financial planner, and we're doing work for your business, even if it benefits you personally, that's also a tax deduction for you. So that $16,000 in taxes that she's paying, that she paid last year, that could have easily hired an advisor and still have tens of thousands of dollars in not only savings but growth. So, and to get the deduction for any of the advisory fees that they were paying to implement these strategies. So the net amount is actually even less than our individual clients as well. So there are huge benefits to looking at having someone help you. And what I can tell you is that if you look back last year and you look at all the things that you didn't implement, what is the likelihood that you're actually going to implement them the following year if you didn't do it because there was a snag, right? So if you're not fixing the snag, then you're going to be so much better off delegating, which is what we do well anyway as business owners, delegating that piece of your financial well-being to someone else, just like you do your CPA. So all those pieces of the puzzle, in the long run, it's going to save you a ton of money in taxes, and it's going to increase your personal wealth because you have someone looking at your situation and strategizing. So hopefully that makes a little bit more sense cost-wise. So I'm going to share my screen so you can see some of the plans that I'm talking about. And of course I hit the wrong button, but we'll get it up here. I'm going to show the different contribution limits for some of the different plans. So here are some retirement plan saving limits. Now this is actually for a client who's age 52. So when you look at this, if you can see my cursor there, these limits also include what's called a catch-up provision, and catch-up provisions are available to anyone who's age 50 or older. And what that allows us to do on the simple plans, which is here, I'll explain those, it allows an extra $3,000 a year, and for the 401ks, it adds another $6,500 a year. So if you're under 50, you would just deduct these from these numbers here. But the different plans that we see for business owners, I don't see simple IRAs as much anymore, but for small businesses that have employees that want to put in a low-cost retirement plan and allow their employees to contribute to the plan as well, this is a easy, simple plan to put in place. But as you can see, as the entrepreneur and the business owner, it's a maximum of $25,000 that you can contribute to those plans, and that's with the catch-up provision. So if you take the catch-up provision out, then it's about $22,000. With the SEP IRA, which I see much more common with our single entrepreneurs, the maximum is $57,000, and this allows us to put 25% of our income in, or $57,000, whichever is less. So in the case of my client that makes $100,000, then they would be able to put $25,000 in the SEP. So this just gives you the maximum limits for these plans. Now, with the solo 401k with the catch-up provision, it allows us to put even more in the plan, $63,500. That allows us to add that $6,500 to that plan. And this solo 401k, again, this amount is both employee and employer contribution. So $19,500 plus the $6,500 is the employee contribution, and the remaining amount is the employer side contribution. Then we have a little bit of a different animal, this defined benefit plan. Most people recognize this when they've worked for larger corporations back in the day where there's a pension. So a lot of our school systems, our school districts, our state employees, our federal employees, our healthcare system, they still have pension plans for the most part. But for most companies, they stopped in using the defined benefit plans because when you have a lot of employees, you're contributing to all of them. But for the solo entrepreneur or the small, if you have a family business, or if you have a business like a partnership, which we find a lot with doctors and attorneys, you can actually create a defined benefit plan that maximizes moving that business revenue over to your personal wealth. And I'll show you some examples of typical defined benefit clients that we help and what those tax savings are. But you can see here, if you just had a defined benefit plan for this scenario, this client could actually contribute $202,400 of their business revenue. This is just what they're paying themselves in a salary. And this is what they can move from their business, which would give them that business deduction and generate and put this into their personal wealth side without increasing their personal income. Excuse me. And then this is what it looks like if we combine the solo 401k and the defined benefit together. That same client could actually end up contributing as much as $245,500. So I wanted to show you those numbers so you can see, as an entrepreneur, I mean, you have right there 5 different scenarios and strategies that are possible. And what we do as financial planners for business owners is that we look at your situation. We look at your business cash flow. We look at your personal cash flow. We look at what your goals are for retirement. And then we work backwards. And just knowing that even if you can't contribute the maximum, you can start and know that you can increase those numbers every year so that you're not missing out on that growth. And you saw the pain of just missing 1 year and then the pain of missing 10 years. So I have clients that come to me late in the game, 45, 50, 55 years old, and they are making good money. They're generating a lot of revenue, but they have not put in these strategies. So I'm going to show you a couple of different scenarios of what our typical clients are that we help, our business owners, and what you can do if it's late in the game. If it's early in the game, don't miss out on time. Make that happen. But it's not too late if you haven't been doing it. And here's some strategies that I'm going to review with you on what some of our typical defined benefit clients are. And I'm going to look at both what the defined benefit and if we incorporated a defined benefit plus a 401k. So this is an owner-only business, which a lot of my clients are solo entrepreneurs. They may have independent contractors and things of that nature, but this consultant is currently age 52 and pays themselves a W-2 income of $300,000. All right. And there's a retirement goal of retiring at age 62. So that's 10 years. That's not a lot of time. And they have not done a lot of retirement planning. But if we put one of those defined benefit plans in place and we only did that based on their revenue and income, they could actually contribute $202,400 in 2020. Just that contribution is saving them, assuming this tax bracket of 37%, that's going to save them almost $75,000 in taxes. And if they're able to just do that over the 10-year period, the projected defined benefit accumulation amount is going to be $2.7 million just in 10 years. And what that also allows us to do in this scenario is actually give that client an annual defined benefit of $230,000. So essentially creating your own private pension plan. And this person is able to do this in just a 10-year period. I mean, this is starting late. And it's not that they haven't accumulated other assets. They have a nice house, they have other real estate holdings and things of that nature, but they didn't have a lot of assets that would produce income for them at retirement. And so putting this in place and saving them a significant amount of taxes would allow us to give them an annual income that they actually are comfortable retiring on. And then if we contributed to both the defined benefit and the 401k plan, then he could actually put in $245,500 and save over $90,000 in taxes. So to say this person wasn't happy, I mean, they were pretty thrilled to see that not only are they saving the taxes, but it was a way for them to transition business revenue into their personal wealth portfolio. So this is a very common scenario. And if you're making $100,000, this is going to be a plan that probably benefits you. It's just a matter of looking at the numbers and going forward from there. So another typical client is an employee with a side income. So we do have a lot of people that are employed, W-2 employees, and then they are generating consulting revenue as sole proprietors and things of that nature. So the objective for this client was to reduce their taxes on the side income. And this person happened to be a professor also in the 50s and also had another 150,000 in sole proprietor income. So this works for not only our clients that have corporations set up, but also our sole proprietor clients. And it was looking at all the different ways they were generating income and a shorter retirement goal period of age 62. So we only had 6 years to make this work, but look how actually beneficial and how efficient this is. From her side income, we were able to transition 138,100 to her retirement plan, her defined benefit plan, and that saved her 51,000 in taxes. Over that 6-year period, only 6 years, she will accumulate almost $1 million. That's going to give her an annual defined benefit of 81,000 in her retirement years, over and above and beyond what she's putting away as a university professor and the monies that she's going to get there. So that's a fairly typical scenario as well. That's really helpful. And then even more typical than this first owner-only business is the owner-only W-2 that has W-2 income that fluctuates, right? Because that's what people tell me a lot. My realtors, other consultants, is that my income fluctuates. So how would I deal with that? This person happens to be a consultant engineer on the younger side, so age 48, W-2 income of 185,000 for the year, but not sure also if it's going to be that high. And as a matter of fact, it was just around that this year. It didn't fluctuate too much, but there were some dry months and then they made up for it. But they have about a 14-year time horizon for their retirement goals. And so in 2020, just on the defined benefit, based on their income and what they had in revenue, they were able to contribute 164,400, which saved them over 60,000 in taxes. And if they just did that over the 14-year period, then they would accumulate over 2 million, and they would actually end up with a defined benefit for about the same amount as they're getting in salary now. So they were really happy with that. And that's what the difference in having 5 years, 6 years, or 14 years makes in these benefit programs. But highly beneficial that on an annual basis, they're saving about 60 grand. So over 14 years, imagine how much money they're saving just in taxes. So we're talking about $1 million just in taxes that they are saving. And then the other scenario that is very common is we look at a spouse that has self-employment income. And we're looking at someone in their 60s actually earning about 100,000 in bookkeeping, their self-employment practice. And that's been the same for about the past several years. They don't need the money now and they want to invest it. So they have 2 incomes in their household. And so they wanted to look at, okay, let's live off one income and invest the spouse's income for 5 years. And so being able to do that is quite a luxury. We don't see that as common, but it's definitely out there. And in that scenario, out of the 100,000 in self-employment income, we were able to contribute 92,000 of that to their defined benefit plan, save them 34,000, and give them a projected defined benefit accumulation of over 500,000 in just 5 years. And that would give them an additional annual benefit of 46,000. So I wanted to show you some different scenarios because a lot of times people will say, well, my situation is this way, my situation is that way. But that's one of the things that I really love about working with business owners is that every situation, there are little nuances. And that's why I love working, especially with my women entrepreneurs, because there are so many varieties of businesses out there. And it's just a matter of looking at how to implement a strategy that makes sense, that follows cash flow, and makes you look at planning ahead of time versus doing it all at once when you see your CPA. Because again, people usually don't do tax planning. Tax planning, in order to do it properly, tax planning should be done in the current year. Like I said, I'm doing that right now with my CPA. I do that every single year because I want to know, are there any additional strategies? Am I going to have a tax liability because maybe I had a better year than I did last year? How can I secure some of these things that have to be done before the end of the year that have to go through payroll deduction, so that we get that benefit? And then what things can I fund after the year but before I file my taxes? So you can do additional planning if you put it in place now. And again, you saw a bunch of different scenarios where we've saved $16,000 in taxes, or we've saved 74, 51, 60,000 in taxes in 1 year. So multiply all that by 10. That's the pain point that you should be looking at. Imagine not doing some of these strategies, and over a 10-year period, you realize I paid $600,000 in taxes that I didn't need to, and the lion's share of that tax savings would have gone to your personal wealth and your savings and investing for retirement. So I just want to reach out to my female entrepreneurs, my male entrepreneurs too, but I get calls more and we're implementing things because there's a different culture. And again, I was trained over the last 30 years, most of my training out in the field, I was trained by my male counterparts. There were not a lot of females in my industry. There still aren't percentage-wise, but 30 years ago, 20 years ago, we were a very small percentage. And so I know the information just isn't getting out there. And as I talk to my female clients, my female business owners, my colleagues that are female business owners, and they bring something up that allows me to share options, they're just not aware. And that's the part of the financial puzzle that's harmful to business owners. And that is not knowing what you don't know. You know what you know what you don't know. And then there's a bigger piece of the puzzle. The most dangerous piece of the puzzle is not knowing what you don't know, that can cost you dearly over the years. And again, if we could send people a letter or a bill saying, hey, if you don't implement this, this is going to be your bill, which is an actual tax bill. There are ways for you to restructure what you're doing that's a fraction of what you're paying in taxes or missing out on personal wealth. Then I think more people would understand the value of putting these things in place. But again, this information over the years still seems to be very convoluted to a lot of people, even to the point of knowing if you need a portfolio manager or a financial planner, and when do you need both. And so I'm coming to you each week to hopefully give you just a little bit more of information, and hopefully coming to you today. Remember, it's December 11th, so you have 20 days, less than that because of the holidays, but 20 days between now and the end of the year to possibly take advantage of some of these strategies. Don't wait until you do your taxes at the beginning of next year for this year, because you've eliminated some of your options. So just so that you know as well, we are working in between Christmas and New Year's for limited time during the day, but I do have space for a handful of business owners that need to put some of these things in place and have someone that could do it in a timely fashion so you can take advantage of some of these things. So if you have questions, this is the best time to set up a one-on-one with me to see what's even possible for you. And if it makes sense for you to work with us, then you can make that decision. But this is what I'll also say: if you don't work with us, work with somebody. Work with somebody. And if they're not giving you this type of information, then they may not be the right fit. Make sure you're working with somebody that understands the culture and the nature and the benefits of being a business owner and all the nuances that go into that. so that you can have someone who is basically your biggest cheerleader when it comes to investing in savings. Like, my clients hear from me at least quarterly when they're on a business regimen that has defined benefit solo 401ks, where I know they're going to maximize those more if I can work with them in the good months to put more money away, and on the leaner months we put less money away. But at the end of the day, at the end of the year, they have much more set aside. Their tax savings is much higher, and their revenue transfer from the business to their personal is just amazing, especially when we look at compounding that over several years. So please take advantage, talk to somebody, talk to us, make sure you're not missing out on these benefits, and make sure you're understanding more of what you don't know and what you should have in your own situation. So I hope this helps. I hope this was good information. I look forward to talking to you. Make sure you're putting things in place before the end of the year so you don't miss the deadlines. And if you have any questions, give us a call. We're happy to help. And I hope you guys all have a really wonderful weekend, getting ready for the holidays, whatever that looks like for you this year. And please be safe, stay healthy, and we will see you next week for Friday's Focus on Finances. Bye, everybody.